But bull volatile, uh, unlike the bull quiet, which wants to hang exit by exception,
You losing him?
Yeah, he's freezing up.
Yeah, I'm missing him too.
Ken, if you hear us, you're frozen at the moment. And
Yeah, he's not even giving us robot. He's just
no. We'll give him another 30 seconds and then everybody can read what he's got on the screen there.
Oh,
He dropped.
Yeah, he's probably going out and coming back in.
Yeah.
David and Greg, can I ask a real quick question while we're waiting for Ken to come back in? And then when he pops in, we can just bounce right back to him. But when you were looking at these numbers, you were only selling puts in the SPY. I for some reason, or in the index, or you weren't going to sectors and other things, right?
No, we looked at sectors as well. So XLK came back with an SQN.
Oh, XLK, yeah, I remember.
XLK
Yeah,
and XLE were probably the two favored. Yep.
Yeah. Right. So yeah, that I believe I love the concept, this concept of selling the premium. I think did you see your particular what Tasty Trade was going to give you in terms of margin for doing this? Basically selling naked premium.
so margin, we looked at that. It was about $10,000 per one SPY contract. Was the
Right.
margin. I mean, much lower for the other ones because of the dollar value.
Sure.
We were only going to be using one contract per 50,000 because again, this was not a main strategy. The main reason why we didn't tinker too much is because I was a big advocate of not curve fitting this.
Sure.
Because we put in our assumptions ahead of time and we use the data, and once you use it, you burn it. You can't go back and tinker with it afterwards. So yeah. It limited our flexibility to change this and change that, because then we kind of lose the
Yeah. Well, this gave you the conceptual framework for that, but once again, you jump into looking at spreading that margin requirement, that capital efficiency should just explode, because you can cap that downside by throwing in that insurance piece, and you're going to get a lot more capital efficient with that. But conceptually, you've shown you got something. So it's an interesting thing to toss in, like you say, among other things. So
Yeah.
Ken, I'll back to you.
yeah, I thought I was being remarkably clear, and I was actually absent. Sorry about that. It sounded good. So let me start just in case. So the bull volatile is always going to be more concerned about capturing the abnormal gains, whereas that bull quiet was more concerned about just avoiding losses and getting what the market will routinely give you. We're going to remember that volatilities are not symmetrical. They climb up the stairs and jump out the window. I'm going to show you in the risk Z concept how I try to operationalize that, so that when the market is coming into a window where the next 1, 2, 5, 10 days are more likely to be large, that's where the abnormal gains may be found. So I want to try to solve the philosophical problem of how do I anticipate volatility? Taleb says you can't do it, but there's practical engineering ways that you can. What I thought was really excellent about this was the insight that when you're in a bull volatile, then it's normal for it to oscillate to bull normal and then back to bull volatile. In fact, what you really want is that's the buy on dip phenomenon. When you have these small, localized moments of sprinting, but you're still running. You have the strength of that bull, which has given everybody confidence to buy the dip, and it's a self-perpetuating. So what it's important to note that you're looking at a bull that's raging periodically. And I thought Dan's insight was especially pertinent, and why you got to be very careful about how you characterize the bull. And that is that you could be in a bull market where you're 20% above the 200-day moving average, but it's decaying. And so there's confidence coming out of that aging bull. And so I'm going to suggest that the slope of the 50 is once again going to be your friend when you start. Is this a young bull or an old bull? Young bulls tend to be volatile, where you're getting a bunch of new money coming in that was on the sidelines and is buying everything, and that's triggering momentum, and you're going to get these repetitive volatility spikes early into a bull market. And then you want it to be oscillating between volatile and normal, and that's that long-term buy on the dip. So just study what happens after COVID, and you'll see that that's exactly the case. So now when you have a runaway move and you got in somewhere, the exit is the thing that matters. And then on the diagram, you can see the blue line, and I'm trying to decide, do I want to sell on the front side of the hill or the far side of the hill? You know, on the way up the hill, you don't know where the top is because it's in clouds. Rats. So one thing you can do is say, let me use a money management strategy. Let me measure all the previous excursions that were abnormal. And if I get a 3 sigma move, so this thing is 3 times the stretch, or it's well above the long-term excursion, maybe that's the time when I start being more ready to get out, or maybe I just take a profit target. When you take a profit target, you'll be sad because that's the time that it really went on to heaven, and then you miss that. So what this led us to the last couple years is we were looking for opportunistic ways to exploit that bull that came out of the COVID. Is we said, should we be an aggressive sniper that's taking it when we see it, or should I be a assistant manager at McDonald's and just trying to follow a conservative rule that makes a lot of hamburgers and gives away maybe some of the premium, but allows me to participate for as long as that thing runs? And should I do this or should I do that? How do I optimize that? And then the moment of Zen was, hey, dummy, just put half the money on each one. And sometimes the sniper will be great because he got it, and then the thing fell all the way back to the manager who gets out, and then you have the satisfaction that the sniper was right that time. But then other times, the sniper will get out, and it'll pull back, but the manager will stay in, and then that thing resumes, and if you have a re-entry strategy, it's good. But sometimes the manager, in retrospect, will be the smart guy. So just put half on each one, develop your re-entry strategy for the half that got out, and then be satisfied with the manager when he gets you completely out of the position, because now you know your most conservative approach triggered, and now you can get out with complete satisfaction. That single psychological trick removed about 90% of the angst associated with routine exit management. And here's why that's important psychologically. In this kind of a trade, and in the trend following trades, you're going to make about 10 decisions in the life cycle of that trade. The first one was, how do I get in? And the last one is, when do I get out? And if you've got a good strategy for exit, that's rule-based, and you didn't even have to decide because the price kicked you out. So it's not a decision you even have to make. So the intermediate 8 decisions that you made, every single one of those was an exit strategy anyway that didn't fire. And all you had to do was raise your stop to account for your aggressive sniper who's capturing gains. So if you had 10 decisions to make, the first one is the entry. The next 8 were decisions you made to lock in a little more profit so that the exit was satisfying. And then the last one, it hit and you're exited. So 9 out of the 10 decisions you're going to make are associated with exit management. So that's the one that you got to get right. And that's even more important on this one, which is an opportunistic system. So I would invite you to think about, how do I make that management decision to adjust the stop efficiently and routinely and in a way that satisfies me, that wherever it gets me out, I was satisfied that I did my professional job. This one, I want to just compare and contrast where the money comes from this one compared to the bull quiet, and why you need a third system. So you would not want to sell your bull quiet positions so that you could fund this short-term opportunistic one, or you've defeated the purpose of the first system, which was infrequent trading. So what that means is you got to have some other place where you have readily available capital that's working for you in a way that you can get in and out of that thing routinely, and then have capital available for this short-term moment, and then back to work. So you need that. You're actually going to need a third system in between those two so that your capital is not inefficient. One of the ways that you can take advantage of these bursts of volatility is to think about Alexander Elder's triple screen idea, in which he was trading the daily bar. He used the weekly bars to set up for broad conditions, daily bars to see the contrary move that he was going to fade, and then an hourly chart for the tactical breakout. So he could actually localize the decision and get well started at a point when there was a maximum opportunity to move. My research into broad market gains and losses says something like this: that if you went out and found the worst and the worst 20-day, 10-day, 5-day, and 1-day, it turns out that 3/4 of the 40-day loss was in a bad 20 days, and 3/4 of the bad 20 days was in a bad 10-day, and 2/3 of the bad 10-day was in a 5-day. So it turns out the market really doesn't like volatility, except guys like you that are trading it. And 5 days of maximum pain is about all it can take. So if you're trying to take advantage of a bull that is also volatile, recognize that the window in which that thing is exaggerated is 5 to 10 days. And use that as sort of as a framework for when this thing has to be in and out, and am I capturing those moves. Now that also means that I think you need a good dashboard system that tells you when you are approaching battle stations for that 5 or 10 day window, and then you can activate the A team to really concentrate and execute with precision your exit strategy. Now, what I want to say also on the bottom here is that's not only a picture of typical price action where it's monkeying around and then you get some kind of breakout to the upside, you get the exaggerated move which then starts a slow fade, and so then you can decide, do I sell on the near side, do I sell on the far side, how much do I give back? That should be a function of the statistical performance of that instrument over a large period of time. Learn what it does, especially when you're trading these big fat indexes, which has rule-based money following it. So it's gonna not repeat itself, but it's gonna rhyme. I also want to say something about comparing XLK, the tech, to those 3 sector spiders: energy, finance, and materials. Technology tends to do that, to lead the market up in long legs with buy on dip opportunities, because that's the promise of an unlimited future. So everybody wants it while they want it. Energy, finance, and materials, however, are cyclic sectors that they are much more like band trading, which could be tilted up or down, but they are much more characterized by band trading. When the banks are in favor, it's because money's at an advantage and they're making their money, and then they get done, and then they cycle. And then E, F, and B tend to cycle at different times inside the broad S&P. So the S&P could be going up, being dragged north by tech, but E, F, and B will give you shorter term, almost business cycle moves that have a different have a different frequency, I should say, different amplitude and frequency than XLK. So as you're looking at timing these moves, recognize that those subordinate elements, even though they're part of the S&P, have different behaviors as they go through time. I want to show something, if I may, how I'm trying to work on this exact problem in a practical way every day. I take the position that two things are going to lead to abnormal returns. It could be the location of the price within a trading range, and the exceptional range in the top 10% and bottom 10% is when everybody who sees that gets nervous that, oh, is this the breakout, or is this just going to revert to the mean? The other interesting location is the absolute mean itself, the fence sitters, because it turns out if you can actually bracket that and it simply moves to the previous support and resistance, you can frame that as a 3-to-1 trade just inside the channel. But if it breaks out of the channel, it could be enormous. But if it just moves to the edge of the channel and starts to reverse, now you're going to get a big move in the other way. So simply by appreciating where your instrument is in a set of defined look-back periods, location itself can lead to a higher probability of short-term large moves in the near future. Oh, it's a breakout. Oh, no, it's a failed breakout. You're going to get volatility in there. Location can help you predict the arrival of volatility in the short term. The second thing is volatility itself. And so what I've just arrayed on the right-hand side is like a 30-period look back. This, I happen to be looking at 5-day ranges because that's where the volatility, and I went back 150 days, and I characterize the 5-day volatility of those 30 elements, 30 sets of 5-day volatilities. And then I found the max, the min, the average, the plus or minus 1. So I'm very alert when the instrument I'm looking at has a 5-day volatility that is absolutely abnormal to the upside, because that thing is already in play, and there might be a second leg up or it might be a reversal down because the run is done. So abnormal volatility is a predictor of a change in volatility or a change in direction of price. By the same token, at the very quiet end, the absence of volatility magnifies the first move and could trigger momentum and might lead to more volatility. So I am concerned about abnormal locations and abnormal volatilities in order to predict a higher likelihood of a large move. I want to shift now and talk on this one about the VIX itself and suggest I've been doing this for about 15 years, and I'm still doing it, and it's on page 1 at the top of my daily market health check. So that's what gets my attention all the time. And this is what I mean by location and volatility. On the left-hand side, you see I'm looking at 2-day, 10-day, 30, 90, and 270. I'm looking for extreme conditions. And I'm alert to market classifications. By the way, in my system, we just went into bear quiet yesterday. That's a good thing. On the right-hand side, under this risk Z indicator that I want to show, whoops, sorry, hit the wrong button. I'm not going to go way into the weeds on this one, but what I do is I take the 10-day moving average of the VIX and the 30-day moving average of the VIX, and I look back 180 days, and I just compute that ratio, and then I plot that as a Z-score of where is that ratio today. When volatility is declining, the 10-day MA is always lower than the 30. And when there's an explosion of volatility, the 10-day goes much higher. So that ratio is very sensitive to a sudden change in the VIX, which predicts 5 or 10 days more of abnormal behavior. That's what your opportunistic system wants. So when I plot that on a time series by Z-score, look how smooth that red and green oscillator is. It turns out that when that thing gets down to Z-2 and then starts rolling up into the spring and crosses the zero line and becomes green, that move from -2 to +2 Z is a beautiful directional increase of volatility to the ups and price to the upside. So when it gets to a peak and starts to roll over, I am paid by letting myself know that this is a time when all of that goodness could be over. So you can actually practically anticipate changes in volatility in spite of what Taleb says. So your system, which is looking for volatile moves in a bull, you might want to know where the thin ice is before it breaks. And you may also want to know how far has it ever gone before everybody's just exhausted, and I want to preserve the maximum gain. So without babbling too much longer, my position would be that on your system, as you refine it, you will be satisfied only when you have a dashboard that allows you to routinely drive that race car safely, reliably, repetitively. And what your dashboard needs to do is allow you to make decisions on the basis of those signals. Once you get it to where you're satisfied, how you turn that into a simple dashboard for execution is going to be the determinant of whether you actually do it or not. You know, having a great system that you don't use is common. Ask me. Having a dashboard that lets you easily implement it is essential, and that's what I wanted to say about that. So, thanks for the dime. I'll send you those slides here in a
Thank you,
quick
Ken.
minute.